there's like numbers climbing up. So why don't we get started? So it's I just want to introduce you to Sakshi. Here she's presenting. She's one of the associate partners here at Inspire, and she will be co-presenting the session today. And if you've seen me in other webinars, I'm Riz. Nice to see you guys again. If you haven't, nice to meet you. But I just wanted to share a little bit about us, Inspire, and who we are as well. If you don't know who we are, we're famous for helping our small business clients through their business journey, especially when it comes to the tax that we help them save as well. You can't really see there. I think that's a bit of a it's going to test your eyes today, but it says $28 million. There you go. That's how much tax we've saved our clients as well. And we've been recognized for some amazing things in the last kind of couple of years. And we've made it into the finalists for some accounting awards as well. And yeah, just super humble to be able to deliver all this stuff to our clients and also the public as well. And just about me, myself, again, if you know me, nice to see you. But if you don't, my name is Riz. I'm originally from Malaysia. I joined Inspire back in 2016. Recently became a new dad, which is a big part of my life right now. That's little August. He's just turned 1 last month. And I'm really excited to be here today to share a little bit about the estate planning, asset protection strategies that we have. I do look after a bunch of lovely clients here at Inspire as well, and we've been able to fortunately save them quite a bit of tax this year, up to $2.2 million. So a lot of hard work has gone through to get that done. I need to balance that out a little bit with taking care of myself. So I do enjoy a bit of a Peloton ride. So if you do want to join me on a ride, feel free to add me at Rizal Ramzan. And Sakshi, did you want to introduce yourself?
Yeah, thank you, Riz. So a bit about myself. I was born in India. I don't know if you can tell or not, but then I moved to Australia with my parents almost 19 years ago. So it's been a long time. And I've been an accountant for 10 years, but I joined Inspire 5 years, almost 5.5 years ago. And I've been here ever since, loving it. One of the things I love about why I joined Inspire was Inspire's all about creating legacy and creating generational wealth for our clients. So that's something from migrating here with my family, that's very close to my heart. And this is why I was very excited to do this webinar along with Riz this morning, because when everything's good, everything's working. But when something happens, this is when you need wills and estate planning and making sure your tax affairs are in order so that your loved ones can be taken care of and, looked after, and they know what to do next if you're not here. In 2023 alone, my team helped save clients just over 800,000 in tax savings. We are very proud of it. And just in terms of photos, I have my lovely family here. My brother will absolutely kill me if he knows his photos are being displayed. He's not a photo person. So, but yeah, and start of this year, me and my brother made all the way to USA to meet my grandma, who we haven't seen for 5 years now. So it was an amazing trip. But yeah, like I said, this morning, 1st of December, we want to talk about business owners or individuals who have not thought about estate planning, wills, things like that. We want to just put some limelight to it and importance of it, why it's important, and yeah, go through that webinar with you, and hopefully we have some success out of it, and share some insights and personal stories from there as well.
Cool. Awesome. And yeah, just putting this up front there, we'll post a link in the chat box as well. Some of this stuff, especially when it comes to estate planning, starts getting quite deep and quite personal as well. So I do recommend getting in touch with us one-on-one if you want to discuss your personal situation. Obviously, what we're talking about today is going to be quite general. We're not going to be able to kind of dive into everyone's personal situation. I don't think some people want to either. So it is a highly confidential call, super private, the 20-minute call that we have. Just talk about how we can help you with some of this hairy stuff. And yeah, it is a conversation that needs to happen. And yeah, we try to do it in the most kind of efficient and also most informative way as possible. Some other stuff as well, just about us. Promise we're going to get to the content in a second. We recently launched our It's All Sorted book, and it's a 9-step guide to help you master your tax and achieve a peace of mind. So if you're a business owner and you do need a little bit of help, or do you want to do a bit of studying or self-studying and reading, feel free to click on that link there. Oh, sorry, you can't click it, but we can share that link there in the chat box if you want to reach out and grab the book. It's by our very own founder, Mr. Ben Walker. Very exciting stuff there. Enough about us, enough about what we're doing. We've got a bit of stuff to cover today, so I'm going to jump straight through it. The first part is actually going to take you through a little bit about asset protection and what it means when we talk about asset protection. Really, it's just general strategies around what you need to know around protecting the assets that you have accumulated or the wealth that you've accumulated over time. As you know, running a business can be quite a risky endeavor. We want to make sure that not only you have tax strategies or profit strategies or business plans, we also want to have a strategy around how to protect your assets. So, Sakshi, did you want to take us through the first part here?
About covering your assets. Yeah. Right. Thank you, Riz. So estate planning is a 2-step process. It's not just about putting your wills and making sure that you have your affairs in order if something happens. The first step is to make sure that your assets are protected. So part of our estate planning process, we want to make sure that as a business owners, we review your structures and your assets to make sure that, they're protected. And also if there's any changes required, what are those changes, discuss it with you. As a business owner, as many of you are, you might be aware that, your business has 4 categories of risk to a business. So your business has risk from clients. Riz, if you want to just press that. Yep. Clients, suppliers, employees, and competition. So we want to make sure your business is protected by these categories. Now, the way we do that is we review your structures and making sure that you have the right structures in place. But also when we review the structures, we want to make sure that what is your risk continuum. If Riz is pressing, you will see it on your screen. There you go. So when we set up a structure, we want to make sure you're at the right side, so on the middle to low risk side of your risk continuum. So ensuring that you're set up in a structure that provides it's not as risky as possible, and the structure is protecting your personal assets, because the worst thing that can happen is you're trading, you're making all this money for your business, your family, and it is up for grabs. So we want to make sure you're not on the high risk side. Now, when we look at the risk continuum, there's different structures that are available to you to trade in Australia. As you might be aware, one is a sole trader, which is on the high risk side. And then the second and the third one is like trading through a company or a trust or a combination of 2, which can be from middle to low risk side. Ensuring that you're in the right structure is the number one key for you and for your family's legacy and wealth. Why it's important is that, say, for example, if something happens in your business, your family home, your personal assets, such as your bank balance, car, things like that are protected. So when we set up a company or a trust structure where you trade from or even buy assets from, we want to make sure that these things are protected, and we ask you the right questions to make sure who's the risk taker and who's the asset protector in your family. Now, obviously, there's no structure where, we can foolproof you from everything. If you are trading through a company or through a trust, you are protected under what we call a corporate veil, which is basically a PTY Ltd can be sued and the company can sue someone. However, as a director, if you commit one of those 4 things, you are not protected, and this is where your personal assets can come under the firing end as well. So as a director, if you commit fraud, obviously you're not protected under corporate veil. You can, the courts can ask you to sue you, and your personal assets can be under the limelight, and you might have to sell it or something like that. Director's guarantee is the most common one. So say, for example, you rent a space, a commercial property for your employees, and then the landlord says, hey, if the company can't pay the rent, you need to give director's guarantee. So you're personally guaranteeing yourself, your personal assets, or giving your director's guarantee that you will pay if the company can't pay. Trading insolvently, that's one of the other ones. And then the fourth one is superannuation. So if you have employees and you're not paying their super and the company doesn't have cash, things like that, then as a director, you are liable to pay for their super personally as well. So we want to make sure part of our review process when we do set up wills and estate planning is the first step is to make sure that your business structure is set up correctly, because that's the number one key. And as we go along in this webinar, you will see why it's so important and how it's all interconnected with the estate planning process. Now, I did touch base a little bit before. When we set up a structure or when we review your existing structure, we want to make sure there's a risk taker and an asset holder role in your structure. Why we want to do that is a risk taker is basically someone who will be the director of trading entities. There will be a director of a trustee company. So if you're trading via a trust, we want to make sure you have a corporate trustee, which is a PTY Ltd put in place, and you're the director of it. So you basically making sure that the asset person is not the director of a trustee company. And ideally, we want to make sure the risk taker holds no assets in their personal name. Now, flip side to that is we have someone as an asset holder who basically will be who will control your assets and holding entities, examples such as asset trust, bucket companies. You might have come across those terms if you are an existing client with Inspire. We use this terminology quite a lot. But if you're not an existing client, that's something you might need to look at with your current accountant as well, to make sure, you have asset trust and bucket companies, and who is the trustee and appointers of those. We want to make sure the asset holder owns 100% ownership of family assets. Now, this can be home, cars, cash at bank balance, things like that, jewelry, things, safe deposit, things like that. We want to make sure they have the ownership. And typical roles of asset holders are something like they are the shareholders, or they're the trustees and appointers of a asset trust. So if you're trading through a company, for example, the company's shares will be held through a trust, and they control basically the trust. So that means that the trust is the asset entity, and we want to make sure the asset holders are controlling that. Now, if we go through the next one, like I said, asset protection review is the number one key, is very important when we do the estate planning process. We want to determine that there's a risk taker and an asset person in your family group. If I reflect back on my personal family parents' experience, both my parents are accountants, believe it or not, but they are not tax accountants. One's into CFO, financial advisory, and one's into audit. Back in the day, I think 7 years ago, my parents had a business. They had 3 businesses, and we had fuel stations. My parents were always in that mindset, no, everything needs to be 50-50. They came from that generation where, everything needs to be both in mom and dad's name. And I was in that mindset as well. But when I joined Inspire, I realized the importance of risk taker and asset protection, why it's so important. Because if something happens in one of the fuel stations, all our personal assets can be affected as well. So I went through this cycle with my parents, and trust me when I say this, it was back and forward with them, because they were like, No, but mom and dad, we both own this. Yes, we both own this. I understand. But it was so important to make sure dad was the risk taker and mom being the asset person. And that was one of the steps we did to get the estate planning sorted. We had to go through and separate the roles in the companies and the personal assets they own to make sure that, we have two people, one as a risk taker and one as an asset person. It took me a while, but we finally got through it. And now that they reflect on it, not only it helped with the asset protection, but even from the tax perspective, it helped massively because dad was on a high income compared to mom, and so many issues with when they sell things. So it helped quite a lot with the sales of the asset. So it's really important that when we do estate planning, we have that overview of your structure and we first determine who's the risk taker and asset person in your family group. Part of it, like I said, existing structures, including review of tax efficiency. And this is why it's so important as well. It's not just about asset, but also making sure the structures you have set up you're minimizing your tax. Now, I'm not saying avoid tax. No, we want to pay the right dollar tax amount to the ATO, but it brings like that tax efficiency. You're not paying too much tax and you're utilizing your structures that you have set up correctly. Now, strategies to improve asset protection. When we review it, we want to make sure the things that we look at is investment ownerships, who owns the investments. Like I said before, it might be a little bit hard if you own properties between risk taker and asset person. We don't want to just make a statement just sell it, transfer it, because then there will be stamp duty, CGT issues. But we will look at investment ownerships and give you our feedback, what do we need to change, or if you do sell it and buy a next property, where should it be, or in things like that. We want to look at business ownership. So we want to look at, okay, if say dad was the director of the company and something happens to the dad, who's the successor director? We want to make sure you have those things put in place, because if dad is the signing authority and God forbid something happens to him, the business still needs to be running, right? We need to have successor directors put in place so that they can pay the bills, buy things and sign off on things. So we want to make sure the business ownership is set up correctly, but then also the succession planning of it, like who's the next person in charge if something happens. Gifts and loan back strategies. There are a lot of cool ways we can, when we review structures, to look at, if you owe money or if the business owes money, what happens to those things as well. So that's one of the things business owners don't look at because that money just doesn't disappear if something happens to you. So we need to put in place like gifts and loan back strategies in there. Asset trust, to making sure even that is really important. Going back to my family structure, my mom is the asset holder of all wealth, right? But if something happens to her, who will be the successor of that? Who will make the decisions, just as if something happens to dad, who will make the direct decisions on directorship? Then if something happens to mom, who will make the decisions on assets? So that's really important. And then also making sure securing debt owed by from trading entities. So how can we secure debts? This is in relation to Division 7A loans, things like that. And if company has, if the directors have done what we call guarantees, things like that, what happens to this debt as well? So why it's so important is making sure, the first step is to make sure that there's two separate roles there, risk taker and asset person. And we look at the strategies to improve your asset protection. And then step two, what Riz will discuss, is how do we protect it, or what will happen in the next steps in terms of your wills and estate planning.
Thanks, Sakshi. And I love the using the example of your parents, and I think that's exactly right. As you guys go through today, I do want you to think about who is doing what right now, So who's your asset holder or asset person? Who's your risk person? Because it's important to understand all that stuff at the outset. Because if and I guess take a step back, if you don't have an asset protection strategy just yet, that's the first thing that I would look at fixing up first, making sure that you do have the split between those two roles, or just having a strategy, just understanding what happens if let's say something bad happens, you have to liquidate the business. What would happen to your personal assets? Those are the questions I would ask. Because once that's set up, it's really the next step. It's about what happens if the asset person or the risk person passes away. That's really where we kind of combine the two, where asset protection kind of crosses over into estate planning. Because if either one of those people pass away, where does control live? Who can access the bank accounts now? What happens to payroll? Who's going to pay payroll now? There's all these little things that can come up and can cause quite a bit of stress, right? Having an event such as death happening in your family is already a 10 out of 10 event. It would be so important, and it would be such a relief to know that, hey, we already have a systemized plan after that happens, for you to be able to look after the business, or, and for you to be able to kind of keep the business going, because especially if in a situation where the business is the sole income for your family, we want to make sure that things still keep moving while you sort out things like probate, looking or even just finding the wills where they are, talking to your lawyers and accountants. We want things to keep moving, because those things can take quite a bit of time. So control of that stuff needs to be very clear. If anything untoward was to happen. So what I'm going to kind of touch on today, on the second half of this webinar, is about leaving your legacy. I'm going to take you through a bit of an example. And also at the same time, I'm going to take you through what are the key things to look out for. Now, here's a bit of a interesting kind of fact. About 60% of Australians die without a will. What that means is there's no plan after death or what happens to your assets. Now, if you leave your it up kind of up to when you let the cards fall where they may, it might be a little bit of a mess, because your loved ones will have to deal with kind of the public trustee and the government to see how to split out your net estate. Now, as business owners, obviously we're planners, we're future focused. We need to make sure that there's a plan in case something like that does happen. Now, especially if you've got a bit more complicated structures, we want to make sure that all those structures have successor appointers, successor directors, and we know who would take control of that. Thank you. Now, what that means is creating an estate plan. It's so much more than just creating a will. Now, creating a will, I'll just dive into this specifically. A will only deals with your personal assets. So as a person, as an individual, if I have a bank account with Riz's name on it, the will that will fall into my estate, and it will deal with my personal assets. Now, if I have a bank account that's in the name of a company, that's different. The will doesn't deal with that because it's not my personal asset. It's the bank account of a company. So the question that you ask is, who then can control that bank account? If I was the director of that company, if I pass, what happens? So that's something that needs to be clear for everyone. Just because you have a will doesn't mean everything else is looked after, especially your business owner. Now, when we talk about things like companies, trust, and super, like I mentioned, you need to understand who are the successor controllers after that, who's going to take control. Now, with a self-managed super fund, or even just generally as a super fund, this is one of those things where people say, oh, I don't really need a will. I don't have much assets. The things that get kind of forgotten is your super. Your super is an asset. What happens to your super if you pass? At the same time, the insurance policies as well. So we talk about, like your life insurance sitting in your super fund, if it's helping super, that's a big sum of money. Where does that go? We need to understand all that stuff. So even if you don't have actual kind of physical assets like a home or anything like that right now, you still have assets that you can pass on in the event of your death. So key things to look out for. And this is a bit of a cheat sheet on like where to look for some of this stuff, right? Like if you ask the question, who takes control? Where do I look for that information? So anything in your name, any personal assets is your will. That's where if you look at your will, it says the first beneficiary will be, let's say, it will be, if I pass, it will be my wife that takes over all my assets, my personal assets. So things like my personal home, my personal bank account. Now, if I have a property in joint names as joint tenants, that doesn't fall into the will. What happens is the survivor takes ownership or takes control instead. So my wife and I have a property together. We're 50-50 owners. If I pass away, my wife takes over that 50% ownership of that property. You have to understand that if it's only in joint tenants. Now, if your tenants in common, that's something that you need to look at, because that's a specific percentage of the property that someone owns. Typically, we see that with like two siblings buying a property together, and they want the property to own 50-50. There's a percentage ownership of that. That needs to be dealt with through the will instead. Now, for a company, we need to look at it when we talk about control. Who's the ultimate controller? Is the shareholder. So, simplest example I can give you is there's two roles: a director and a shareholder. The director, although feels like they're in control, the shareholder actually hires or fires the director. Now, that's important to understand. If you're the majority shareholder of a company, you can decide who the director is. So ultimately, when we look at companies, if you want to understand control, we want to understand who is the shareholder. Now, if you know who the shareholder is, the next question to ask is, what happens if that shareholder passes? Where does the shares go? Now, if the shareholder is an individual, then it goes back to the will, right? Now, if the shareholder is a trust, and this is typical, especially if you're clients of Inspire, you'll see that we set up companies where the shares are held in a trust. Then you need to understand the next level here. Who controls the trust? So obviously, if the person that controls the trust is the same person who controls the company and they pass as well, then the next question you have to ask, who now controls the trust as well? So you got to read the trust deed. So the idea of that is, in the trust deed, there's two roles as well. There's a trustee and a appointer. I'll show you some diagrams in a second. The trustee and an appointer, and where the appointer hires or fires the trustee. So the appointer has the ultimate control over that trust. Similar to a company, shareholders has ultimate control. The trust, the appointer has ultimate control. So you need to understand who the appointer is. If it's the same person that has passed, you need to see if there is a successor appointer, because that leads to having control over the trust, having control over the shares in that trust, which has control over the company. See how it kind of leads on together. So if you're following along really closely, you might think, oh, well, if I set it up really well, if I pass away, I can automatically have the succession set up to the right person, because it's all linked together. So what we want to make sure that we do is we understand what that flow looks like, but also understand who will be that successor in the case that I'm no longer there. I'll share some diagrams after this again to kind of take it to the next level down. In terms of super, we talk about nominations or binding death benefit nominations. Essentially, what we're looking for there is a legally binding document within your super fund, whether retail or self-managed, that says, here's where my benefits in the super will go to. So it could be a person, it could be an estate, and it's separate to the will. Again, all this stuff is separate to the will. Lastly, insurance payouts. Like I mentioned before, you just want to check who the policy owner is, because that's where the money will go. Now, if it's in the super fund, obviously it will go to the super fund and it will go to the nomination as well. So it's linked. So this is the stuff that you want to clearly understand. Now, you don't have to kind of remember it every day, all day in your life, but having a review of it. And now, something that's important before I share the diagram is when we talk about, we'll just skip to this next one here. When we talk about reviews,
Sorry,
remember,
Riz, we can still see asset protection review.
sorry,
All
let me
good.
see, this one is.
Yeah, asset estate planning is not set and
Yeah,
forget. Yeah,
perfect.
perfect.
Thank you. So can I just check? Was that showing all?
No.
Oh goodness, someone should have said that. Sorry. Sorry, I didn't realize that I was using a different one. So in terms of the documents required, what I was talking about just now, that would have been super hard to follow. If you did, well done. But don't worry, I'll cover this again in my diagram in a second. That's the cheat sheet that I was talking about, where to look for some of this stuff. Now, taking back to that conversation again around it being something that you have to review, it's not that you have to remember everything all the time and then change it every year or every every month or something. It's just some key things that happen in your life that you want to make sure that you review to just check that the estate plan I have is it still makes sense. So one of the things that we want to check on is if we were single when we did our estate planning, now we're married, we want to make sure that that's obviously a big change, right? Now you've got two financial worlds combining. How does that work for each other? So when we talk about wills, it's always individual. There's no such thing as like a family will. It's like if that person passes, what happened to that person's assets? It usually passes to the spouse. Now you want to that does mean that it is linked between two people. Okay. On the other end of it as well, if there's a marriage breakdown, that's something that you want to check in as well, just to make sure that you understand if my assets are all going to my spouse right now. If I have a marriage breakdown with her, then I might not want that. I might want my assets to go to my kids or my siblings instead if I was to pass, or my future partner as well. Um, kids is if you have a newborn, like myself, I just went through a bit of we're actually doing our estate planning this weekend, fun. But in terms of having kids, obviously you want to just check. Now most wills, they allow for future kids, so it does say in there future kids as well. It doesn't necessarily mean that you have to change it, but there's specific things that might come into play. Because within an estate plan, within a will, there's also sections like before the net estate is distributed, there's things like specific gifts. You might have had conversations with your child, since they were born and they grew up. You're like, hey, look, when I pass that car, that classic car that I have in the garage that you never can drive, you will get the keys to that. That could be what we call a specific gift. So you want to make sure that you include that in your will as well. So reviewing things like that is important, but also just making sure that you still have your estate going to the right people as well. Now, when we talk about time, over time as well, things change. Not only just legislation, laws, and things like that. So if you've set it up, years ago and you haven't looked at it or you don't even remember what it looks like, it's just worth bringing it up again just for a review. Doesn't mean that you need to change. We recommend regular review of your estate plan overall as well. Also, over time, what I find is your structures also change. If you're a business owner, as you make more profit and more wealth, it usually gets a little bit more complex, and you want to make sure that those new structures also include an estate plan overview on top of that as well. Because ordinarily, when it's set up, it's just set up to invest or set up to run a business. You want to make sure that there's estate planning, succession planning of those structures as well. Now, if you're going to be traveling or going to be out of the country in the extended time, then you want to be considering what that looks like as well. Or if you're taking any high risk activities as well, this this happened in World War II. They all made all the soldiers sign a will, make sure that happens. So you want to make sure that you do have something like that in play. That's the same as well with health, because if you're unfortunately diagnosed with something that has it's terminal, you want to make sure that you're reviewing that way before you lose any capacity, because there will be a challenge. An estate can be challenged if you were to do it closer to a point where you don't have capacity to do that, and you just don't want that mess to happen. So which kind of says as well, you've got to look after your wealth, and having those checkups will be really important as well. And that's something that I just want to know, if there is something that's pressing and that that, oh gosh, I'm going through this time right now, I just want the peace of mind of my assets being looked after. There is we can do urgent immediate estate planning straight away for you, just to kind of take that weight off you as well, just to kind of review everything as a whole, make sure there's a plan forward so you can really focus on getting better. Now, the last bit here is wealth. I talked about wealth growing over time. If you have your wealth growing over time, just naturally by the way of managing the wealth, managing the tax, managing the risk behind the business, you will have more complex structures. And also generally, the bigger the estate as well, there's bigger risk in someone contesting it, because especially if you have complex issues like a blended family, or you have ex partners, or kind of strange siblings or children, and you have a big estate, big wealth. it is likely that, they're saying that it is likely that that might be challenged if it's not considered fair. So there's things like that that you want to check on as well. Now, before I move on to the estate planning process, I just want to introduce this idea of a testamentary trust as well. I see some questions coming up. I might save the questions for later, just because I want to share this diagram that I've prepared as well. But I just want to introduce this idea of a testamentary trust. Now, a testamentary trust is a form of a trust that's written into a will. Now, just like any trust, it's just a asset that's being managed by a trustee on behalf of the beneficiary. So to put it quite simply is when you pass, this will activates this trust. When this trust exists, then when you pass, what happens is your net estate, after paying all its debts and stuff, is distributed to the testamentary trust instead. Now, why that's important is if you think about we go back to asset protection strategies at the start. If you were to pass away and everything was to go to the person directly, like kind of option one here, you're kind of resetting the clock again on your asset protection strategy. So the successor of your wealth will just have to restart their asset protection strategy again. They have to start it on trusts and bucket companies and things like that. Whereas if you have a testamentary trust, it sets them up really well, because from this point onwards, now the wealth that you've given them sits in a testamentary trust, and there's a few benefits to that. Obviously, asset protection is the key one. It's not held in their personal name if they were doing something risky or they were a risk person, and you just don't know what that might look like for them, 20 years down the line after you've passed. Now, at the same time, there's also a tax benefit as well. Now, if you have minors who are under 18 and you pass before they turn 18 and your assets are transferred to testamentary trust, usually what happens is you have the executor of your estate or someone to look after, as trustee, to look after that trust on behalf of those minors. But as the money sits in that trust, it might invest in some shares or properties, whatever that looks like. It might make some capital gains or income, dividend, whatever form of income. Now, like a normal trust, it will have to distribute that income. Now, the benefit of a testamentary trust is if you distribute that income to a minor, that minor is taxed as if they're an adult, which is a massive tax benefit, because right now, if you're less than 18 years old, if you're younger than 18 years old, then we can't distribute any income to you, and you don't get the tax-free threshold, whereas a minor can receive this. So just on that alone, a testamentary trust becomes almost like a no-brainer. And how it can be introduced is you can have multiple as well within your will. If I pass away, my net estate gets distributed to Jane, Bob, and Joe, all of them held on trusts, testamentary trusts, and it'll be 1/3 across all of them. And it's as simple as that. Now, remembering that as well, it still is dealing with your personal assets, because it's only from your will. I'm going back to that. It's only from your will that testamentary trust is born. Now, if you have bucket companies and asset trusts that hold properties and things like that, we just need to make sure the succession follows, or the succession of that control follows as well your raw estate planning. Some of the benefits as well you can build in is you can build in some rules within the trust when they can access the money. What are the rules that you want to introduce? Some dramatic examples, Joe has a bit of a gambling addiction. We want to make sure that this person doesn't just spend it willy-nilly. So someone else controls the money and kind of pays them a bit of money over time instead. Also, you can build in rules around who can benefit from this trust. Remember that this trust, ultimately, what you want to do is, if they're below 18, ultimately, once they turn 18 or 21, whenever you think they're responsible enough, you give the control over to them. What you can also build in that trust is exclusion of beneficiaries. So you can actually exclude people that you don't want to benefit from this trust. And this is the term that we use, that it's kind of protecting the bloodline. So the only way I can explain that easily is kind of like the royal family. The empire kind of passes along within the same bloodline. So you can introduce rules in there to say only the people who share the same DNA or the same bloodline as Joe or Jane, whatever example I used before, can benefit from this trust. So going forward, it's only their kids, their children going forward can benefit as well. So that's that kind of multi-generational wealth succession planning that you have in there. It doesn't mean that their spouses can't benefit. You can introduce in there as well. It just depends on how much control you want over the wealth that you're passing on. Cool. So we've got about, I think, another 15
And
minutes.
just to add a little bit about testamentary trust, like from personal example, it's really important to have it. Like I remember, unfortunately, I went through a marriage breakdown, and this having my parents setting it up just make sure that the wealth, my parents' legacy was not going into someone else's hands. Like it's protecting as well. You don't know what will happen in the future, right? And we just want to make sure that the wealth and the legacy that you guys are working so hard for like goes to your kids, and then they create to your grandkids and so on. And like yeah, like it just gives that extra layer of asset protection, I would say.
Yeah, thank you, Sakshi. And I got a few questions in here in the Q&A, but I feel like I'm just going to go through this chart.
Riz, you're
Sorry.
not sharing your screen anymore.
Yeah, thank you. And
Yeah.
I'm just going to switch to a different
Yeah.
program here, just because I think if I share this, might answer some of those questions, but I'll try. I'll revisit it again towards the end. Can I just check before I start talking? Am I sharing my screen right now?
Yeah. We can
Awesome.
see owned as joint tenants.
Perfect. Okay, here's a bit of a case study example, just for those of you who are a bit more visual rather than just talking about it. Here's a really classic example of a trust setup with a trading trust, a trading entity, a trading trust with a corporate trustee, and then an asset trust with a bucket company where the shares of that bucket company is held in an asset trust. If you don't know some of these terms, I'm not going to go deep in what they are right now because we've got not too much time, but feel free to reach out to us. And also, we have a husband and wife with property, their own home, own as joint tenants. Now, I've kind of highlighted what and their roles are: the husband's a risk taker, the wife's the asset holder. Husband runs the business, but the sorry, just delete that. But the wife holds all the assets of the family. So if you think about anything on the right, that's the assets, and then just the risk stuff is coming from the business side. Now, the thing that you have to ask the question is, if the risk taker was to pass, what happens to that role? Because that's the role that the risk taker is taking. What happens to that role? And what does it mean as well? It means that the person that runs the business, the director, controls the corporate trustee, which controls the assets of the trust, which bank accounts and things like that, signing off documents, payroll. If that person passes, we need to understand what happens immediately, right? The immediate effect is I can't access the bank accounts in there. I can't pay payroll. I can't. There's a lot of stuff that just stops. So we need to understand what happens there. Now, as you can see, most of the other assets are held by the wife right now. Now, in that sense, it's only that the running of the business comes into play. It doesn't mean it, because what usually happens here is if that person passed, all the assets that the risk taker was holding would pass generally as a first level of beneficiary to the surviving spouse. Now, so the it's not as complicated. Now, if you have an asset holder, that's usually where most of your your wealth is being held or being controlled. If the asset holder passes, you can see there's a lot more to think about, right? A lot more to think about. Now, the things that we need to ask the questions, the one that I prepared earlier here, we just need to ask, who are these people? So in the event that the risk taker dies, who's the successor director? Now, does it make sense for it to be the spouse, or is there someone that was that has a business as well, knows how to do payroll, that they can take over for that time? I've had different, and this is where we kind of get into the customization of it all. There's no one set rule who the successor director should be. Sometimes it's the spouse because they do the books anyways and things like that. Now, in terms of the if the spouse was to pass or the wife was to pass, the asset holder was to pass, there's the questions around who's going to be the shareholder for the corporate trustee. So I'll just remove the blue ones again, just to reduce the complication here. But if she was to pass right now, all the cash or the assets sitting in the bucket company, the shareholder who controls that was her. Who controls that now? Well, we know that the shares are held in the trust, and the trust is controlled by the appointer, because the appointer can get rid of this trustee here. So really what the question we're asking is, who is the successor appointer? We need to ask that question now. Because if she passes, the ideal situation here, if he survives her, is that obviously he takes control first. Now, it might be an interim solution just to take control, but long term, remember that this person is a risk taker, We don't want them to control that family asset for long. But again, it's something that we just need to review. Maybe not during that time when a death has happened in the family. Now, I also had a question. So sorry, I'm just going to wrap this up because I'm not going to go any more detail other than that. But this is the stuff that we want to be asking questions. Who's the successor appointer? Who's the successor director for each of those companies? And also who holds the shares of those the corporate trustees after passing. Now, in terms of levels, usually what happens is if one of the spouse passes, it passes one to the other. Doesn't have to be that way, but that's what we see in practice. Just makes sense. Now, what happens if both of you pass? Now, that's a really unfortunate event, but it does happen. If both of you pass, then you need to really consider who's going to be the new level of risk person and asset person for the next level down. It could be siblings or parents. It could be your children if they're 18. But you also have to think about who's going to be the guardian of your kids as well. So that's included in the wills as well. We talk about that, and also guardians of any pets or anything like that. Now, what happens if both of you pass, and also really unfortunate event, all the children pass as well? That's another level down that we need to plan for, or we can plan for. If we can't pass it down to our kids, who does it go to? Is it siblings and parents and things like that again? So this is the process that we go through when we do your estate planning with you. And the way that it works, which is a really good segue, I must say, I'm kind of proud of myself there, which really works really well in terms of the next topic here, in terms of the process itself. Now, the process it's us, the Inspire, you and the lawyers working together. And the process is called the advisor facilitated estate planning. And this is where we know about all your structures. We know about, maybe to a certain extent, about your family dynamics. And also we know about your personal wealth as well. This is where we come in to make sure that we translate that to the lawyers really clearly, where those wealth sits and what structures you have in your family situation as well. Where you come into play is literally just the wishes, right? So we ask those questions: what happens if this person passes, and who takes control, and where do you want your money to go on to? So it's through an interview process between the two of us first, and we ask those questions to you, and then what we do, then we pass those wishes on to the lawyers, and the lawyers essentially provide recommendations. Or if it's really complex, the lawyers might have to come in as well and meet with you to facilitate it, as well as drafting those documents. But ultimately, what happens is the lawyers gets the instructions, they prepare the documents, and then they give legal sign off for those documents. What I didn't cover as well is we talk about wills just now. One of the other things that we talk about is power of attorney documents as well. So power of attorney documents, in a nutshell, is it gives someone the power to make decisions on your behalf if either you lose mental capacity, or even if you just want to. So it doesn't have to be. There's a misconception that it only activates when you lose mental capacity. You can actually activate it as soon as you sign it. And some people say that works well, just because sometimes it's really hard to prove you losing mental capacity, and at what point you need a doctor to say that. So sometimes it's just easier to just activate it. But obviously, there's a high level of trust if you're doing that, right? So the lawyers also talk about, the lawyers will also draft those power attorney documents. And usually what happens is when we do your wills, it will inform us of your wishes. We can easily plan the other stuff like the power attorney documents, and also the successor appointers and directors, because then we know what your wishes are. So there is kind of like the first domino piece is through doing that interview with you first. Now, so there you go. So we do a bit of planning, summarize, sent to lawyers. We have a 3-way meeting with the lawyers. We prepare the documents, and we have a signing meeting as well. Depending on the state, as in like physical, which state you're in, Queensland, New South Wales, there is different requirements for signing as well. Now, yeah, this is just a bit of remember that.
And just to go back on, going back to 2 steps with power of attorney. Correct me if I'm wrong. It's really important to have that, like, say for example, you're in an accident or something, and you haven't passed away, but you're just like, someone has to make health decisions for you. So it's really important to have that in place, so your spouse or like someone you trust can make those decisions, especially if you don't have a partner, if you need that surgery or something like that.
That's right. And I think and again, it doesn't activate doesn't need to activate on losing capacity to make decisions. It can activate immediately, and this is the stuff that we work with lawyers in terms of their practical experience, right? Like they've seen this happen legit when it happens and it gets activated. What are some of those practical challenges in using some of this document? So you're absolutely right, and it's all about just making it easier, because remember, if these documents come to life, it's because something bad happened, right? We want to make it super easy for the people who are looking after us, or the people that survive us as well. Um, cool. Now, in terms of estate planning, we do have a bit of a pricing for you guys as well, because we do work on fixed price and we work with lawyers with this stuff. We do provide what's included in our estate planning packages. First of all, we need to determine whether it's a simple or a complex one. To put it easily for you to kind of kind of decide which way you guys are in. Complex is if there's a lot of complexity in terms of the estate being challenged, or you have strange relationships. And it's kind of the opposite of simple, where if I pass, I know where it's all going to go. Everyone's going to be happy. We have quite a good relationship and understanding. Also complex being if you have people from overseas that you want to pass the money on to, things that are not in Australia. Generally, we do want to involve the lawyers there. So the key difference there is you have a shorter meeting with the lawyers, or you have a more involved process with the lawyer where they're facilitating the conversation as well, and the interview as well with you. So that's the simple and complex. Now, what it includes is we do up your family tree. Obviously, we do your business structure review as well. I recommend doing that anyways beforehand. And then we document your assets and liabilities. That's important. It pays for our fees and our time spent for the interview, and also liaising with the lawyers. And obviously, it pays for the legal fees itself for them to sign off and also give you that advice. Pays for the printing. We do have a secure storage on offer. This is just where to keep your wills. That's an optional thing if you want to use it. And then we've got wills and the power of attorney and the memo of directions as well. It includes testamentary trusts, and that's kind of like built into our wills anyways, just because it kind of becomes a no-brainer for us. There's no real reason not to have that, but it is built into your wills. Now, in terms of pricing itself, we charge, this is for a couple, by the way. So you're talking about two sets of documents, two sets of wills, two sets of power of attorneys, two sets of wishes, and it might be different too between the two of you. And that's where we charge. For the simple one, it's 3,625 plus GST. And then for the more complex one, that's kind of the starting price. It can go up. I've seen some of it go up to 5 figures. But yeah, it really depends on how complex it is. But we can scope that for you. The reason I'm kind of, so if you're interested or you have any questions that you want to ask before we go through this process, just book a call with us. This is kind of towards the end of it. If we want to go through and do your wills, it might be some simple questions that you just might have about your structure and your personal wills first. So I would suggest, we're going to post a link for the strategy call. If you do have very personal questions that we can't talk about in the webinar today, feel free to reach out to us as well.
And also, just on the pricing, just be mindful that the pricing that we've put is for existing Inspire clients. Now, if you're not an existing client of ours, the pricing might be slightly different because we're not familiar with your structure, things like that. So we might need to spend a little bit of extra time with you to understand what your structure is, understand your business, things like that. So just want to be upfront and honest about it, that yes, if you're an Inspire client, we know what your structures are, but if you're not, the pricing will be slightly different.
Yeah, and that's just a kind of benefit of having your accountant involved in this process, right? Because if we already know a lot of the stuff, we don't have to spend time doing it. We probably set up some of the structures that you have as well. I should mention, so the pricing doesn't include the succession planning on the companies and the trusts as well. Any variations that we need to do there, or any successor pointers, that's a case by case basis. We just don't know. It depends how many companies you have, how many trusts you have as well. Cool. I'm going to jump into the questions just because we're towards the end. I'm mindful of everyone's time here. Let me just have a look. James Robertson. That was a while ago. I'll start there first. Did you want to go one for one for this one's actually?
Yeah, for sure.
Cool. Is it wise to place assets and IP within a holding company that charges the trading entity a licensing fee as well as being a corporate trustee for the family trust? uh we, as you can see in my example, we try to separate all of them together, rather than having, and again, risk is a spectrum. You can always go super risky or not risky, or super less risky. I guess that's the way to say it. Now what you're saying here is you want to separate your IP and your assets. That's fine, that increases your asset protection, but where you're putting it kind of decreases your asset protection, because what you're saying is putting it in a corporate trustee that of a family trust. Now, it does complicate things a little bit when we talk about asset protection as well. Oh, sorry, estate planning as well, because then if it's a corporate trustee for your family trust, what does your family trust hold in terms of assets? Because then if we want to make sure that the IP and the assets of the business is dealt with separately from your family assets, you've kind of combined the two and kind of mixed it up. So it doesn't make it very clear. But also at the same time, if that family trust is a trading entity, then we're kind of putting all that assets back at risk again, because the corporate trustee is the one that has a target on its back as a trading entity. Good
Yeah.
question.
Yeah. The second one is like, will you be able to have copies of the slides? Very handy. Um, I think we
Well,
do send recording links.
I'm not
I
sure if
think,
we. I'm not sure if we do. We'll just check. And Rose, if you could post an answer for that in the chat,
mm,
that's a little bit of a question. I don't think we share the slides, but sometimes we do share the recording itself.
yeah. I can answer the next one as well, just because the first one I didn't really answer. What happens if shareholders and directors pass away at the same time and no children for trust and company? This it depends on like what you want to do with the business, I guess. Do you have a close family friend, or like uh, cousins, siblings, things like that, if you want to pass it on to them, and depends on your close relationship with them. If you do have that relationship with them, you might want to leave it with them. Or I've seen a client who has actually left instructions for the lawyers to liquidate everything and donate as well. So it all depends on like what your instructions are, and this is where lawyers can also give you some suggestions as well.
Ooh, awesome. The next one is, what do you do if assets such as property, cars, etc., already owned jointly by husband and wife? How to reset or redo it? There will be transfer stamp duty involved. Yeah, you got to break it down. Things like cars, usually there's not much value in it, just because unless you bought it outright and it's some sort of collector's car, making assumptions here, but usually people have a bit of a loan on it, and really the values is the equity, call it, on it, it's nil. So I wouldn't worry too much about that, because what would happen if you were to pass is you either pay out the debt, or you pass on the car and the debt across to someone else as well. More often than not, they just sell the car. The property is a bit tricky, because there's stamp duty involved. So, and that can be quite expensive depending on the value of your property. Usually, what we say is we kind of draw the line in the sand. So, if you do have a property that's already shared right now in ownership, from an asset protection perspective, it's like, hey, any future properties, let's follow this new estate planning or this asset protection plan that we have. Having said that, there is ways where you can protect the equity involved, and this is where it's actually kind of talked about the gift and loan back situation, where and essentially it's any equity that's available, that's what you're trying to protect, right? Because the rest is owned by the banks. The equity is what whoever is at risk gives the equity to the asset person, and then the asset person then loans that equity back. What happens there? There's no transfer of title. The title still stays 50-50. It's just the equity value itself is gifted, then loaned back. Now, for that to happen, there's a whole strategy around it and kind of steps around it. So I do recommend booking a call for that, just because and also we need to ask the question: is it worth protecting, or do we use that equity and put it into investment property instead? So there's things like that where you can empty the equity out as well.
Yeah. The next one is, sorry, what happens if your will beneficiaries are overseas or non-Australian tax resident? What are the tax consequences, tax-wise and legally? It all depends on like, the country they're in, and also from what you're leaving. For example, I'll give you one of my examples. Based on my parents' will, my dad, he looks after his mother who's back in India, so my grandma. So every month he sends money, so for her medical bills, things like that. God forbid if something happens to him, what we have put in process in the will is there's going to be like and which is like a mutual understanding as well. Like me and my brother, whatever we inherited, part of his wishes is we put aside and transfer the same amount to my grandmother every month. So that's just from what the lawyer suggested us we do. So it all depends on the state. Other one is one of my other clients who are a couple, no kids, no family here, but all their assets are going to their siblings overseas. So what happens there is part of their estate planning. What they have done is wishes that they have actually put, believe it or not, us as in charge. So they want us to sell everything with the lawyers, working with the lawyers, sell everything, and whatever the cash we receive minus our fee, then we can transfer it to their siblings. So it all depends on what country, and we need to look at, like, the tax residency, things like that, and who you want to send it to.
Just to add as well, like in Australia, there's no such thing as inheritance tax, which is a great thing, but there's different countries might have. So we need to understand what the consequences are if they were to receive an inheritance from a foreign country, from their perspective, right? So it is a little bit more complex to answer today. It just depends on the situation, and that's one of those ones where have a chat first, see if we have to grab the lawyers for this one as well. And sometimes you might need an accountant or a lawyer overseas as well to make sure we understand what the impact is for the beneficiaries. Cool. I realize we are over time, so if you do have to roll, I just want to say thank you so much for joining us this Friday. It's been an amazing time sharing all this stuff with you guys. So don't feel like you need to stick around, but I'm just going to go through some of these questions and keep answering them. But thank you again, and if you do need to book a call, feel free to do so. Cool. The next question that we have here is from Matt. Thanks, Matt, for sharing. It's a pretty personal situation you just shared there, so I appreciate you doing it. It's beneficial for people to understand what happens here. Now, if you're in a new relationship now with a new partner, what you can do is, like I said, you can introduce within your personal will and also in your succession of companies and trusts to make sure that it only goes to the bloodline. So you can exclude beneficiaries. So you can actually exclude people, name them and say, look, this person's not going to benefit from this testamentary trust. But at the same time, you can also, what's introduced in the succession of all that is the beneficiaries going forward is only people who share the bloodline with you. Now, if you want to, it doesn't say here, let me just check. How can I show my chart? Okay, it's more about your children than it's just about the bloodline. Now, if you want your spouse, your new spouse or your new partner to benefit as well, then we need to make sure that within the will it specifically names them, or if you pass, the assets goes to them, and then they can only pass that on to your biological children, and maybe a little bit goes to them as a specific gift. So there's a few ways you can do it, but as long as the rules and the beneficiaries say who can benefit from this and who can't, it's pretty easy to kind of hardwire that. Now, I just want to add a bit of practicality here as well. And this, I don't know the situation here, but I've heard from lawyers as well. It's better to give something than not to give anything at all, because then what you don't want is for it to be contested and then the courts make a decision instead. So you can make a decision to specifically give someone who, let's say your ex-partner or someone who's estranged to you, some money from your estate, and then the net estate is then distributed to your child. So that way, then they go, all right, well, they've got something, they've made considerations towards that, and the net estate is the one that's protected through that bloodline rule. So again, one of those complex ones. We want to make sure that you get the lawyer's wealth of knowledge to come through here a little bit. Okay.
Amazing. The next one is for company. If director or shareholders passed away, do you have to inform ASIC what must be done in such circumstances? So yes, it is triggered depending upon who your estate goes down. If your accountant gets notified, and basically from there, if you have successor directors, things like that, they will be informing ASIC and updating things like that. So it's really important to make sure your accountant has a copy and the lawyers have a copy of your estate plan, your wills and estate, and also who your nominees are, beneficiaries, like the next in line should also know what's happening. So, and the key contacts details as well, so they can inform, like, your accountants, things like that, so we can update with the ASIC.
How to appoint successor director is the same as alternate director. The term sounds very similar. We use the word successor director, but essentially it's just a minute of the meeting that needs to be entered into by the existing director, and it specifically names who the successor director is in case the original director passes away. So it's a piece of paper that you sign, and you do want to do that while you have capacity, you're alive, and that's not after the fact. Just to be clear. I'll take this one. Do you provide professional trustee services? We don't generally do that, just because there's lawyers and that can help with that a little bit better than us. So the answer is no. And there are limited circumstances where we do act as executors, but very, very limited circumstances. I think that's the same one. Cool. So you say how we enter the state. I might just finish this one off actually.
Yep.
What do you need to do if you're one of the yes surgery when you enter the state? You how would that enter the state? Great question. Great question there. Now, again, we speak only for Australia here. Now, with the US company that you have, we just need to make sure the same kind of questions are being asked. If you pass away, what control and what kind of vacuum it creates. Now, in Australia, and I can speak for Australia, what we do is we read the rules, the constitution of the company, to see what is actually the rules of the game. Now, usually, what we see in trust deeds and companies is that without an absence of a successor director, it says your executor can take control, or the shareholder can appoint a new director. That's usually what happens without the estate plan in place, without a successor director in place. I would just recommend reading what it looks like over there, and also getting some help over there as well. I don't think it will be. I'm again speaking on through a keyhole here. I don't think it's going to be a full estate plan, but rather it would be what happens with the control of that company, who's going to take over. So I would get help with just understanding those rules. Cool.
Just the last one, sorry, Michael. I noticed you posted in the chat channel some questions.
Yes.
So I just want to quickly touch base on that. One of them was, can we prepare for the successor passing away after the director? What Chris said was, we do want to appoint someone while you still have that capacity, and making sure that the successor director is signed. Now, I can see that you have. You're currently working with Gulshan, and you went through the estate planning with him. So some of the things that you have questioned, I would recommend just sending him an email, because I don't want to comment on things as I'm not familiar with your structure and what that estate planning process went through with what you went through with Gulshan. So I would recommend just sending him an email and making sure that your successor director appointed, things like that, have been set up correctly with him, and he'll be able to best tell you if they were or not.
Cool. Yeah, there's a few questions there, Mike. And when we talk about power of attorneys for your mum, there is levels you can introduce as well. You can have backup attorneys, and that's highly recommended when you do your own as well, because power attorneys, you just don't know if the first line of attorney is going to be alive when when you lose capacity, or when you need to activate that document. So having backups is really important. So we usually go up to 3 levels, and sometimes we even introduce where there's 2 attorneys acting together as well, if you wanted that as well. And Mike, I think we've got some specific questions. Yeah, I might suggest we book. You're a client of ours, so I might suggest booking a call with Gulshan, like what Sakshi said, just to make sure that we answer all those questions with the new information that you've got today. Okay, hey guys, thank you so much. Thanks for taking the time. I really appreciate everyone's time today. It is not the sexiest topic to talk about when we talk about death and estate planning, but it is super duper important. And if anything that you do take away from today is just asking those very simple questions: what happens if I'm no longer around. Who's going to take control of this stuff? Who's going to help? And the thing that I would suggest also is if you do have estate planning or wills already done, and this brings up some new questions, or there's some holes that you want to plug in, and if you're a client of us, just get in touch with your accountant. We'll obviously be able to answer those questions as well. But if you're new to us, this is the first time. Thanks for joining. Thanks for taking the time. I really appreciate it, and thank you, Sakshi, for presenting with me as well today.
Thank you.
I hope everyone has a great Friday, and let's